Okay, this is problem 5-4B. Parker Department Store located in the Mark Twain Shopping Mall. At the end of the company's fiscal year, the following accounts appeared on the adjusted trial balance. There they all are. Unfortunately for us, they put them in alphabetical order rather than in what I call financial statement order, where they have all the balance sheet and the income statement items put together. Anyway, so there's all the information, plus there was $20,000 of the mortgage payable due next year. Prepare a multi-step income statement, retained earnings statement, and a classified balance sheet. Okay, so the easiest way to deal with this for me is to start by going through and just highlighting or recognizing the accounts that are going to be income statement accounts, since we're going to start with the income statement. So I'm going to look for revenue accounts. I'm not sure if you guys can hear my computer making weird noises. If you can, sorry. So there's sales revenue. And then I'm going to look for any returns and allowances or sales discounts, those sorts of things. So there's sales, returns, and allowances. Then I'm going to look for expenses. So cost of goods sold, always the first expense listed. And then all the other operating expenses like, let's just go through the top, depreciation expense, salaries and wage expense. Identifying what I'm working with up front makes this a lot easier for me. You can do this another way if you want. Utilities, there's utilities expense. There should be, I missed insurance expense and income tax expense. Actually, since we're doing a multi-step, income tax expense is going to come later, and I'll explain why. There's insurance expense. Interest expense will also come later. And maintenance and repairs expense. I think those are all the expenses except for income tax and interest. Then I'll look for other expenses, like interest expense and income tax expense. And I'll look for other revenues and other expenses, like the gain on the disposal of an asset. That's a revenue, but it's a non-operating revenue. I think that's all of them. So once I've done that, then I'm ready to build my income statement. All right, so I'll start with my sales. And we'll do sales revenue, which was given to us here as $626,000. We'll go ahead and tell Excel to recognize these two columns as dollars. And then we're going to do and the sales returns and allowances were $8,000. And that will give us our net sales. It's always the revenue minus any returns and allowances or discounts is going to give us our net sales. We'll do our cost of goods sold. which was $412,000. And that will give us our gross profit. Our gross profit is always equal to our net sales minus our cost of goods sold. If we want, we can make this look a little nicer by putting those lines in, but they're not really necessary. All right, next section we'll have is operating expenses. We had salaries and wage expense. We had depreciation expense. Oops. We had utilities. All right, so those are all of our operating expenses. You might be wondering at this point why interest expense and income tax expenses aren't included in the operating expenses. And the reason is when we're talking about operating expenses, we're talking about those expenses that management can control through the operations of the business. So you can control salaries and wages by making sure people don't work hours that they don't need, or even by laying off people. You can control depreciation. That one's harder to control, but they always include it in operations. I guess by getting rid of assets, you can have less depreciation expense. You can control utilities, again, through your behaviors and so forth. Whereas interest, you can't really get rid of interest unless you pay off your debt. And a lot of times management isn't the one who made the decision about taking on debt. It's usually ownership that makes those decisions. And also income tax, you can't really get rid of income taxes unless you die. And even then, there's a good chance they'll come after you for some. So I guess you could make less money and have less income tax, but of course that's kind of defeats the purpose. Anyway, so that's why operating expenses are those expenses that are considered controllable, typically. So let's go ahead. We had salaries and wage expense was $111,000. It's pretty common for salary and wage expense to be the biggest expense with the exception of cost of goods sold for a lot of businesses. Depreciation expense, $23,400. Utilities expense was $11,000. Insurance expense, $8,400. And maintenance and repairs is $6,200. So we'll say total operating expenses which will be the sum of all those expenses. And that will give us something called our income from operations. Sometimes it's called income before interest and taxes, or earnings before interest and taxes, EBIT. So our gross profit minus our operating expenses is our income from operations. Now we'll deal with our other revenues and other expenses. Our other revenues, we had a gain on the disposal of plant assets. That in essence means that we sold some equipment or other plant assets for more than their book value. So we made a gain, which is a revenue. And that amount was $4,300. And we had other expenses. And this is where we will include interest expenses. Our interest expense was $7,000. And that gives us another line item that we call income before income taxes. So this will equal our income from operations plus any gains minus any expenses. Then we'll do our income tax expense. which is 15,000, and then finally our net income. So as you can see, this multi-step income statement has a lot more information, and it's broken out with a lot more detail. There we go. All right, so next we're supposed to do a statement of retained earnings. So let me look through my chart of accounts here and see if there are any retained earnings accounts. Remember, the accounts that have to do with retained earnings would be our retained earnings at the beginning of the period. This says this is the retained earnings at the end of the period. Let's see. So that's retained earnings at the end of the period. And were there any dividends? Yep, there were dividends. We know those will impact our retained earnings. And that's it. Additional data, 20,000 of the mortgage. And it says it was the company's, let's see, at the end of the company's fiscal year, the following accounts appeared in the adjusted trial balance. So it doesn't tell us what the retained earnings were. Well, you know what, though? Since we haven't closed the accounts yet, we haven't done our closing entries, then this must be the retained earnings previously. Okay? That's a good point to bring out. Retained earnings don't get updated until the closing process happens. So as long as we have revenue and expenses on our adjusted trial balance, we know that it's adjusted. It's not a post-closing trial balance. So let's come here. I'm just going to steal this header information to make life a little easier. We'll call it all right, so we will say retained earnings at January 1st. And they were 19,200. We'll add the net income. Net income was 28,300. We figured that out on our income statement. The way this book likes to lay them out, it does a little subtotal. I've seen some that do and some that don't in real life. So the subtotal would be the retained earnings plus net income. And less the dividends were 15,000. So our retained earnings at December 31st will equal the sum of our retained earnings and net income minus our dividends, or 32,500. Finally, we're supposed to do a classified balance sheet. I could highlight all these other accounts as being the balance sheet accounts, or we could just say the ones that aren't highlighted are the balance sheet accounts. Again, I'll steal the header, change it to balance sheet, and instead of for the year ended December 31st, we will say as of December 31st, not FAS of, because that makes no sense at all. That's even worse. Don't judge me. All right, so there it is. All right, so we'll start with our current assets. Those will include our cash, our accounts receivable, our inventory, and our prepaid insurance. Let's see, our cash was 30,000. Our accounts receivable, 43.5. Our inventory, 43,000. And our prepaid insurance, 2,400. Total current assets, $118,900. Then we'll have property, plant, and equipment. That will include our land, our buildings. Of course, our buildings will be less accumulated depreciation. And our equipment less our accumulated depreciation on the equipment. So our land is valued at $50,000. Our buildings were at $140,000. Our accumulated depreciation on the building is $52,500. So here we will show the building minus any accumulated depreciation. If you remember, that's called the book value, which is the cost of the asset less any accumulated depreciation on the asset. The equipment had a value of $100,000. The accumulated depreciation on the equipment was $42,600. So the book value then would be $57,400. Now we'll do our total assets, which will include the current assets plus the land plus the building, the book value of the building plus the book value of the equipment. There's our total assets. If I'd wanted to, or if I'd remembered, I may have titled this first section Assets. The next section will be titled Liabilities and Equity. Remember, the assets must equal the liabilities plus the stockholders' equity. All right, current liabilities. They will include my accounts payable, my mortgage payable, not my whole mortgage payable, right? There's a current portion of it. That's the amount that's due within the next year. So part of a mortgage will be long-term in nature, the other part will be current in nature. Salaries and wages payable, and interest payable. All right, so my accounts payable, $73,300. Mortgage, remember it's only the current part, so that's the part that's due next year, and it says $20,000 of the mortgage payable is due for payment next year. So we're going to put $20,000 here. Salaries and wages payable, $3,500. Interest payable, $2,000. I could have indented these if I was thinking of it, so it would look more consistent. Usually if I'm doing this for my own notes or on Excel or something, I don't worry about it. If I'm doing it for a client, we make it look prettier. Like everything else in life, right? If you're cleaning your bedroom, you do it good enough. If you're cleaning it for your mom, you do it really nice. And if your friend that you actually care about, usually a girlfriend, is coming over and there's any chance they'll see your room, then you make it perfect. Anyway, maybe that's just me. All right, liabilities and stockholders' equity. Okay, so this is my total current liabilities. Which will be the sum of all of my current liabilities. Then I'll have my long-term liabilities. That will include the mortgage payable. Now this is interesting, right? Because we have $62,500 in mortgage payable here, but we included $20,000 of that in our current liabilities. So this is going to be the remaining $42,500. And I think that's our only long-term liability. So in fact, I'm just going to move it over here. So our total liabilities. Current liabilities plus the long-term liabilities, or 141,300. Stockholders Equity section. We'll have our capital or our common stock. Which had a value of 140,000. And our retained earnings. And this is one that we don't take off of here because that was our retained earnings. Where is it? 19.2 at the beginning of the period. Instead, we take it from our statement of retained earnings. So it's 32.5. Total stockholders equity. And that will give us our total of liabilities plus equity which will equal, should equal the same as our assets, right? 313,800. And it does, so now we throw a party. I don't party like most people. My partying involves usually like donuts because, you know, that's what Mormons can have. I mean, we can have other stuff too, but I like donuts. Anyway, so there we go, 313.8. So next it says calculate the profit margin and the gross profit rate. Okay, so let me make this a little bigger. So you can see I went through all of this. There's our income statement, retained earnings statement, and the balance sheet. So now it wants our gross profit margin, our gross profit rate, I think they call it in this book, and our profit margin. So just remember, our profit margin equals our net income divided by our net sales. It's customary to express this as a percentage, and I usually give at least 1 decimal point, maybe 2. All right. Then we have gross profit rate, not rage. I don't know what that would mean, gross profit rage. That's what I get when my gross profit is too low, I guess. All right. So gross profit rate is the gross profit. I'm sorry. Yeah, the gross profit divided by the net sales. 33.3%. All right. The last one they want is the Vice President of Marketing and the Director of Human Resources have developed a proposal whereby the company would compensate the sales force on a strictly commission basis. Given the increased incentive, they expect sales to increase by 25%. As a result, they estimate that gross profit will increase by $50,500 and expenses by $27,800. Compute the expected new net income, then compute the revised profit margin and gross profit rate. Comment on the effect this plan would have on the net income and the ratios and evaluate the merit of the proposal. All right, so there's a couple ways to go about doing this. One is to do kind of what you would call the total method, which would in essence be to just like adjust your income statement. that might be the longest way too, but it might be the easiest for some people. So that's one way to do it. Another, I'm just going to add a column here. Another way to do this would be just to take the current net income, add the increase in gross profit, and subtract the increase in operating expenses. So let me just kind of go through both ways of doing this. So the one, he just tells us that our gross profit is going to, the problem tells us the gross profit is going to increase by 50,500. So here I'm just going to take the gross profit amount and add 50,500. There's the new gross profit. The other tells us that our operating expenses, our total expenses actually, are going to increase by 27,800. So here I'll take that and add 27,800. This assumes, of course, that everything else will stay the same. So that's one way to go about doing this. So in essence, this would give me a new income from operations of 68.7. Then I can subtract. I would just carry all of these things over. Whoops, look at that, it did some weird stuff here. So that could be one way I go about doing this. I think that's the hardest way, but I just wanted to show it to you as an option. The other way, like I said, is simply to say, what was my net income? 28,300. Let's do it right here. 28,300. And then I would add the increase in gross profit, which was, how much was it? See, I'm already forgetting. 50,500. And I would subtract the increase in expenses, which was 27,800. And this would give me the new net income. Net income plus increase in gross profit minus increase in expenses. You see I get the same thing, 51,000 either way. All right, so there's just two ways to attack that. Then the other thing it tells us to do is recalculate the profit margin and gross profit rate. So we'll do that. So here we'll call this the revised, and we'll call this column the revised column as well. All right, so our profit margin then would equal our net income, which was 51,000, divided by our our net sales. So our net sales aren't given to us, so we have to figure that out. Okay, so my net sales here, whoops, so hold on a second. It said in the problem that net sales would increase by 25%. So my net sales would equal the old net sales times 1.25. So that's my new net sales. If that confuses you, what you can do is you can multiply it by 0.25, which gives you 25%, and then add that to the original. It's the same thing. Okay, so back here, you can say my new profit margin is going to equal my net income of 51,000 divided by my net sales of 772.5. my gross profit rate is going to equal my gross profit of 256.5 divided by my new net sales. Again, let's express those as a percentage. Okay. So I think the last part of the problem asks us to, so we computed the new expected net income, we computed the revised profit margin and gross profit rate, and then it says comment on the effect that this plan would have on net income and the ratios, and evaluate the merit of the proposal. So, I mean, the effect it has on net income is more net income. That's good, generally speaking. That's profit, that's money in my pocket as an owner. The other effect it has is an increased profit margin. Remember, profit margin is our net income divided by our net sales. So that means for the same amount of sales, we'd be generating more revenue, okay, or more net income. So that's a good thing. It means we're more efficiently converting sales to profits. And our gross profit rate is roughly the same. So what that means is our gross profit is increasing while both our gross profit are increasing and our expenses are increasing, but the gross profit is increasing at a higher rate, which is what we want. The more we can increase our profits and keep our expenses growing at a slower rate, the more net income we're going to make, which is money in the owner's pocket at the end of the day. Remember, net income goes to, either gets paid out as dividends or it goes to the retained earnings. Okay, so that was problem 5-4B. As always, if you have any questions, let me know. Hope you have a great week.